Okay. Are there any questions from last time? We had been going over this stuff on the capital asset pricing model and combining different assets together into portfolios. The way that this idea gets translated from combinations of single assets into the market as a whole is we're going to combine this idea of a stock beta with the same concept that we had looked at before that dealt with how you can always, if you combine an asset with a risk-free asset, you can get any combination of returns and risk that represents a line between any of those assets. So we looked at that with examples in the past. We talked about how there's possible in anytime you're combining two assets with a risk-free asset, you can if the asset has some the risky asset has some risk and return profile, you can always achieve any line. You can always achieve any level of risk and return on any point between that risky asset and the risk-free asset. You're able to get any point along that straight line between the risk-free and the asset itself. And so that's going to be really important when we think about how assets should be priced, because if you're an investor and you're wanting to get more return for a given level of risk, if there's an asset that is able to give you the same return but have lower risk, that's something that you're going to unambiguously prefer over the alternative. And what that's going to do is somehow force the return on assets to all sort of be in sync with one another and fall along what turns out to be this blue line. This blue line, we're gonna call this blue line on this slide here, this entire blue line. This is sort of the security market line. That blue line, we're going to call that the security market line. It's the same sort of idea as the idea we saw before with combining a bunch of different assets together in the Sharpe ratio idea. The same idea of how any risk and return along this yellow Sharpe line, just as with that Sharpe line, any combination of risk and return along that yellow line was feasible, and that was actually anything along that line is unambiguously better. Any portfolio along this yellow line unambiguously dominates any other risk and return profile on that yellow or on that blue frontier. With anything along the yellow line is either higher return for the same level of risk, or lower risk for the same level of return. Okay. So does everybody understand the idea that any portfolio along this yellow line is achievable based on having some combination of the risk-free asset and any combination along that blue frontier? We went over that a little bit on Monday and Wednesday, but that's going to be a key idea for what we talk about just coming up here in a little bit. So the example that I just gave with the Sharpe ratio, again, that's combining a risk-free asset with only one or two different individual assets. Now we're going to think about combining a risk-free asset with an entire market portfolio. You don't just have one or two assets to choose from. You have the entire market that you can sort of collect a bundle of all the assets in the market to get a nice diversified portfolio. And then once you have a diversified portfolio, the risk contribution of any individual security is going to be represented by the beta. Because the beta tells you what's the additional risk to your portfolio that additional stock or asset contributes. If the beta is, as I mentioned here, if you have a large and positive beta, that's going to be something that's going to increase the volatility of the portfolio. Again, a large positive beta means that when the market is up, when the market's increasing, the returns to that individual asset are going to increase, but by a greater amount than the market. If the market, however, is down, an asset with a large beta is going to actually decrease in returns more than the market. So you're going to lose a lot more when the market's down, but you're going to gain a lot more when the market's up. And so an asset with a high beta is going to sort of increase the overall risk of a portfolio. At the same time, an asset with a small beta or even a negative beta, that's going to be, if it's a small positive beta, then it's going to just, it's still going to be a little bit risky, but it's going to have a less of a risk, smaller risk than the market as a whole. So adding a small risk asset to the market as a whole is going to overall reduce the risk of your portfolio. And then if you have even an asset that has a negative beta, that's going to reduce the risk of your portfolio even more, because if the market's up, that asset will be down, and so it's going to sort of smooth out fluctuations in the market. If the market's down, that asset with a negative beta is tending to be up, and so that's going to sort of cushion the falls in the market that occur, and so it's going to work to smooth out rather than exacerbating the movements in the market. It's going to sort of narrow the band of possible returns. So that's the sense in which the beta is the appropriate measure for the additional risk contribution of a stock to a well-diversified portfolio. Because if you already are holding a well-diversified portfolio, the beta is going to be the thing that determines how much additional risk relative to that portfolio you're going to be taking on when you include that asset in your portfolio. So this security market line is sort of it's analogous to that Sharpe, that maximum Sharpe line, insofar as it represents the combination of all risk and returns that you can get if you combine the risk-free rate, not with a single asset, but with a well-diversified market portfolio. Right, and so we have this relationship here. This is the fundamental capital asset pricing model relationship, where the average return on a stock, according to this capital asset pricing model, the average return on a stock is going to be a function of the risk-free rate plus the beta of that stock. That is, how much it moves either together with the market in an exaggerated way or maybe in a muted way. It's going to be the risk-free rate plus that beta times what's called the market premium, which is the extra return that you expect on a portfolio of stocks relative to the risk-free rate. So a portfolio of stocks is relatively risky compared to the risk-free rate, and so you're going to expect, in order to take on some of that risk, you're going to have to expect a little bit higher return. That's given that higher return that you expect is given by the overall return on the market relative to what you could get in just a risk-free asset. And that's the parameter, that equity premium, or the difference between the average market returns and the risk-free rate. That market premium gets multiplied by the beta, and then that gets added to the risk-free rate to get the expected returns on a particular asset which has a particular beta or a particular tendency to move together with the market or against the market. So the slope of that line that's the security market line that I had drawn right here. This blue line, that's the security market line. And that's going to be the line that's sort of, if a stock is too far off of that line, we would expect that market forces are going to push it back onto that line. So just to, we'll get to that idea in a second, but just to emphasize just the mechanics of this capital asset pricing model. Let's say that we have a risk-free rate of 2%. Let's say that we have a stock whose beta is 0.5, and if the average return on the market portfolio is 7%, then we would say that the market premium is 5%, because you can on average earn a 5% greater rate of return on the market relative to the risk-free rate. You multiply that by the beta, and then you add the risk-free rate. So again, this is the return on the stock is the risk-free rate plus the beta times the average return on the market minus the risk-free rate. And so in this example, the expected return on the stock, given its risk characteristics, given its beta, and the risk-free rate, the expected return on that stock would be 4.5%. So that's just a simple application of the capital asset pricing model. So this is just the fundamental equation. RS, return on the stock, equals the risk-free rate plus beta times the difference between the market rate of return and the risk-free rate of return. That's the fundamental CAPM relationship. Okay, now if we remember from that when we were looking at the Sharpe ratio stuff, we had some optimal portfolio, which would maximize the Sharpe ratio, which would get this line, the Sharpe line, up, rotated as far counterclockwise as we possibly could get it. That's going to represent the most return we can get for a given level of risk. And notice that if we have any other kind of asset, let's say we have a portfolio that's right here, say right here. So everything on this black line is feasible. That just represents a combination of two different assets. We've seen that in terms of the portfolio frontier. Now, if we were to choose something like this blue dot, that could never be optimal, because we could always, if we combine a portfolio on the black line with the risk-free rate, we can always achieve something that's on the yellow line. So if we wanted to, rather than the blue portfolio, we could combine the portfolio that's, say, up here maximizing the Sharpe ratio. So that red portfolio is the one that's maximizing the Sharpe ratio. If we combine that red portfolio with the risk-free rate, which the risk-free rate is down here, this purple dot represents the risk-free asset. Combining the purple and the red, we could always achieve anything on the yellow line. And so if we can have any combination of risk and return between the purple dot and the red dot, we're always going to be better off choosing something that's on the yellow line rather than the blue line, or the blue dot, just a single portfolio on the blue dot, because if we have this blue dot is has a particular level of return, but we can achieve that exact same level of return. So this x-axis, remember, is expected returns, and this is risk. Rather than choosing the blue dot, we can choose anything that's on the yellow line. And so if we are able to reallocate from the blue dot to some combination of the purple dot and the red dot, we can achieve a portfolio, let's say let's say this teal portfolio, which is a combination of purple and red, which has exactly the same expected returns as blue, but it has lower risk, right? So anything on the Sharpe line unambiguously dominates anything else that's on this black portfolio frontier. The only thing that doesn't unambiguously dominate is the red dot, in which case it's identical to the optimal portfolio on the black line. But anything else on this black line, either you're going to be able to get lower risk for the same return, or more return for exactly the same risk. So we could also, if we instead of having the same expected return for a lower level of risk, we could also achieve, the same level of risk but increased returns. So we could move on to a portfolio that's here, right? So that light green dot, that's also achievable. That's also on the yellow Sharpe line, and it unambiguously dominates the blue portfolio because it has exactly the same risk but higher return. So you would unambiguously prefer either of those green dots to the blue dot. That's an example of how, with a combination of two assets and a risk-free rate, anything on the yellow line dominates anything below the yellow line. Because remember, we're trying to get as far up into the northwest corner as we can. The same principle applies with the market as a whole, where instead of representing risk on the x-axis with the standard deviation of the portfolio, we're going to represent risk by the beta of the security, which is the amount by which the individual asset moves either with the market in an exaggerated way, or maybe in a muted way, or maybe in a negative way. So in the same way that if you combine any asset with the market portfolio, any risk-free rate with the market portfolio, you can achieve anything along that security market line just by combining a balanced market portfolio with the risk-free rate. And so in the same way, S would be dominated by anything on this security market line. You could always get something that's the same return but lower risk, or the same risk but higher return. So S would not be, you would not, if you have the option of investing in a market portfolio and the risk-free rate, you would definitely prefer some combination of the overall market portfolio to asset S. What that's going to mean is that nobody is going to demand asset S if they can achieve, if they can achieve this, a circle, either of these other risk and return profiles. If they can achieve, some other profile by combining the market portfolio with the risk-free rate, they're going to unambiguously prefer that to asset S. So asset S is not going to be in very high demand. Nobody is going to want asset S because they can always achieve the same returns of asset S with lower risk, or the same risk with higher returns as asset S. So what's going to have to happen with asset S is that the price of asset S is going to have to fall. Nobody's going to demand it. The price is going to fall. And when the price of asset S falls, then all of a sudden asset S becomes a little bit more attractive. It has a lower cost, and so it's like it sells at a discount in a sense. And all of a sudden, once it is discounted by a high enough rate, that will sort of allow it to move back up onto the market portfolio, or move back up onto the security market line. If the price of asset S is falling, that means it's more of a bargain. And so even if its returns are small, the returns net of the cost is going to increase. You get more returns relative to the cost. And so if asset S, this is sort of, if the price of S, if the price of S falls, this is going to push S back up onto the security market line. Right now it's sitting below the security market line because it has a high cost relative to its return. But if the price of it falls, then it becomes more attractive. The returns relative to the cost are going to go up. And so that's going to be something that actually pushes it back up onto the security market line. And you'd expect the price of that asset to fall until it actually winds up back up onto that security market line. So as long as there's a gap between S and the security market line, you'd expect people to prefer the market portfolio to asset S. And so the price would have to continue further for anybody to continue to demand S at all. And the price is going to drop until S rises up onto the security market line. Does that concept make sense? Is that clear? Is that analogy clear between the two asset example and then the market as a whole example? Okay, so yeah, I just wanted to wrap up with that material. So you can see just on this next slide, asset S has a beta of 0.8. But given the fact that a market portfolio has a certain amount of expected returns, that 0.8 beta, the returns that asset S generates, given that 0.8 beta, are lower than the market as a whole. And so you'd expect asset S to be having to drop in price. It would be currently overpriced, and so you'd expect it to drop in price as a result of the fact that it's currently out of sync with the market as a whole. You'd have the same thing with asset T. It's located below the security market line, and so the returns that you would expect to be generated based on the fact that asset T has a high beta or high risk, the returns that you would need are much higher than the market. But currently, asset T doesn't generate returns that are located on that security market line. So again, you'd have to expect the price of asset T to fall until asset T sort of migrates back up onto that security market line. Okay, that took a little bit longer than I was planning on, but I wanted to just wrap up with that capital asset pricing model material. Notice we have with this CAPM, this has a linear structure. The return on stock S is a function of the risk-free rate plus some parameter. Now this is something that this is something that we can only get by looking at past returns on the market and past returns on the asset. So this is something that we have to estimate. And we're going to use regression analysis to do that. So if you would, I'm going to start looking at the regression tutorial at this point. Is the tutorial on regression, on linear regression, is that visible now on your screens?
Yeah, it is.
Okay. So I'm going to be looking at that right now. I'm also going to be pairing that with Excel. So basically, we have this this linear form that I just mentioned for this capital asset pricing model. This is back on the capital asset pricing model slides. This linear form, this RS plus risk-free rate plus beta times the market return minus the risk-free rate, that's something that we can estimate with regression methods. the idea there is that we're going to have sort of a cloud of data that's going to be representing observations that each have, a certain value for in one dimension, and then a certain value in another dimension. That's illustrated by, say, this cloud of data here, or the relationship between total electricity demand and cooling degree days. So you'd expect some relationship between those cooling degree days and electricity demand. As the temperature increases, as it becomes hotter, in the summertime, the demand for electricity is going to go up as people turn on their air conditioners and use those more heavily. And so you can use information about cooling degree days to sort of predict what electricity demand is going to be based on historical information about that relationship. You can look at data on past cooling degree days and electricity demand. Consider what those pairs were in the past. Each of these dots represents a combination of a certain amount of heat or a certain amount of cooling degree day units, and then a corresponding level of electricity demand. And you can collect that data from the past, and essentially what a regression analysis is going to do is fit a line through that data to try to estimate the linear relationship between these two variables. So I'm going to look at Excel. I'm going to bring up Excel right now and try to share this. Okay, I just switched the screen sharing. Is everybody able to see my Excel window right now? Okay, we got the Excel window visible. So let me just explain first. So the way that one thing we're going to need first, I want to get this in just before we end. The way that you install regression analysis capabilities on Excel is you go up here to File. So if you click on File, this is going to be an explanation of how to install the data analysis package in Excel, which you're going to need for doing the regression analysis in Excel. Go up to File, so click on File. Then go down on the left-hand side menu to Options. All right, so in this Options window, on the left-hand menu, there's the second from the bottom option on this left-hand menu is a bar called Add-ins. So if you click on Add-ins, this will take you just to some extensions that you can install in Excel, which will allow you to do some of these statistical analyses. Once you get to Add-ins, you want to go down here to the bottom, this bottom window, or this bottom portion of the window where it says Manage, and you can select. There's a drop down menu next to Manage. If you go and you click on Excel Add-ins, and then hit Go, that'll take you to this window, which has different options of what you can add into the your Excel program. And if you check this analysis tool pack option, if you check the box right next to the analysis tool pack, and then hit OK, if it's gone correctly, that should allow you to be able to see this data analysis tool. So if you go to Data, if you go to the Data tab along the top of Excel, and you click on Data, on the right-hand side, there should be made available based on what you just did with installing that extra package. There should be this data analysis option available in Excel after having taken those steps I just described. In any case, this data analysis tool pack is going to be what you need to do regression analysis. So there's a bunch of different statistical functions that are in this this data analysis package. The one that we're going to want to use is regression. So if you click on regression and then hit OK, that's going to bring up this window here that's in the middle of my Excel window. If we think about the relationship between cooling degree days and electricity demand, we'd expect the cooling degree days to affect electricity demand in some way. And so this technique is going to be essentially what we do when we're fitting a line to that cloud of data. If you remember that cloud of data that represented the combinations of cooling degree days and electricity demand, this regression tool is going to be something that's going to fit a line as best as possible through this data. So we have, on the left-hand side of the equation, we have electricity demand. So electricity demand is the thing that we want to predict. And cooling degree days is the thing that we want to use to predict electricity demand. So the y variable is the thing that we're trying to predict. The x variable is the thing that we're using to predict that variable that we're trying to predict. So this y input range, this top box in the in this regression, this top box is going to represent the variable, the data for the variable that we're trying to predict. In this case, that's electricity demand. You can click in that box and then select all the data for electricity demand. So start at the top and then drag down and select all of that data. Then the thing that we're going to use to predict electricity demand is cooling degree days. So we want to select that data as well. So we start at the top in column C, and then again, drag that down. And since I've included labels in the box here, I've included each of these data that I've highlighted includes the labels at the top. So I'm going to check this box for labels. And then I'm going to have this output be pasted. You can choose any cell you want to paste the output. I'm going to say F2 is where I want the output to start. And then once you hit OK, that's going to perform the regression analysis. And then this is the output you get from that. So the intercept term is sort of the baseline electricity demand. And then the coefficient on CDD, or cooling degree days, is the extra unit of, or the extra electricity that's demanded as a result of having one additional cooling degree day. So as the temperature gets warmer, there is more electricity demand, and that's what's given by this this coefficient in the bottom row of this table. Now let me just remind you that for the capital asset pricing model regression, remember we have the returns on the stock equal returns on the risk-free rate plus beta times market returns minus risk-free rate returns. So our y variable, remember the form of a regression equation is, is y equals a plus b times x. In this case, we're not going to estimate this equation directly with this capital asset pricing model. We actually we know what the risk-free rate is. We're going to assume that we know what the risk-free rate is, in which case we can rearrange this equation to be of the following structure. It can be, we're going to move the risk-free rate from the right-hand side to the left-hand side. and that's going to be our y variable. So our y variable is now RS minus RF. And our x variable is then going to be this RM minus RF. So there's one key manipulation we have to do before we run the regression, is we have to subtract off the risk-free rate from each of these observations. So I'm going to put in a new column for risk-free rate. I'm going to take new data, which is going to be represented by the returns on the stock minus the risk-free rate. Those returns are going to be given by the returns in that day minus the risk-free rate. So we're going to generate a new variable. And this is going to be the actual X and Y that are going to go into our regression for the capital asset pricing model, is this XOM minus the risk-free rate, which is what's on the left-hand side, and the market returns minus the risk-free rate, which is on the right-hand side. And so if we can do the same process as we just did for cooling degree days by selecting for our Y variable is going to be the stock minus the risk-free rate. And the X variable is going to be the S&P 500 returns minus the risk-free rate, just in the same way that we estimated Y equals A plus BX. In this case, the structure of our regression equation is just RS minus RF equals beta times RM minus RF. So once we've subtracted the risk-free rate, there's actually no A. There's no A parameter anymore in that regression. So we're going to set the constant equal to 0 in the case that we've subtracted off the risk-free rate. So I'm going to select constant equal to 0. And then I'm going to select for the output range, I'm going to have the output be pasted here. So the results of that estimation are that we have a beta of 0.82 for this stock as a result of having data on the daily returns to ExxonMobil and the daily returns to the S&P 500. I didn't have as much time to do that as I would have liked. Why don't you guys, and it's impossible for me to tell anything about how anybody is doing out there in internet land. Why don't we, I mean, class is over right now, so we're going to stop here right now. I have some data for an in-class problem that you can work on for practice. I'll post the solutions to that later, but why don't you try to practice with that data, trying to get the beta based on the procedure that I just described here. If you weren't able to follow everything I did in this this live class here, the regression tutorial document, which is about 12 pages long, has a pretty extensive explanation of how to do this. Refer to that, but I'm happy to take questions either by email or on Zoom if you want to have a Zoom meeting to make sure you understand how to do this regression stuff. But that was a really, unfortunately, pretty rapid overview of that, and I was hoping to get through more of that today, but I was also trying to just review a little bit of what we covered on Wednesday, so that unfortunately didn't work out as well as far as timing goes. So
in this case, would the beta just be that first number, the multiple R?
Yeah, well, in this case, the beta would be the 0.82, which is it's the coefficient which is the, it's this number. It's this number which we're estimating. Our x variable is this Rm minus Rf. Our y variable is the Rs minus Rf. And then we suppress the constant. We set the constant equal to 0. And so the result of that regression is the beta of that stock. It's the covariance between that stock and the market divided by the variance on the overall market. In the chat, it looks like, how do you actually use this data to estimate beta? So these data represent returns in a given day on a particular asset, and each of those data points is paired up with the returns to the market as a whole on that particular day. So as long as you have a bunch of pairs of those two variables, a daily observation of the returns on an asset and a daily observation of returns on the market, as long as you have a pair of those represent sort of pairs of data, XY coordinates, which will form sort of a cloud of data on an XY plane. And then this regression is actually what's being used to fit a line through that data to figure out what the slope of that line is. And the slope of that line in this case is the beta, because beta is the coefficient that's on the market returns relative to the risk-free returns. So that's the x variable in this capital asset pricing model equation. Your y variable is the returns on the stock minus the risk-free rate. That's what this cell is saying. And so if you have those y observations of y, which are the returns on the asset minus risk-free rate, equal to beta times the returns on the market minus the risk-free rate, and you regress that model, the coefficient that you get on the market returns minus the risk-free rate is in fact the estimated beta for that set of data, those sets of asset returns paired with market returns.